Hi guys, good morning. Hope all of you are doing good. This is derivatives revision of concepts class number 3. What have we already studied? We have done the basics of derivatives. We have done futures in details. We have done everything. And then we have done FRA, the last point of discussion in class number 2. If you have already done that, you would have seen that we ended the discussion with FRA. And now we are still left with 3 more topics. We are now discussing the most crucial topic. I know most of you are waiting for this. We're discussing about options, and apart from options we will have cap, floor, collar discussion left, and then we will just go through, brush up the concepts of financial swaps. Now I always say this, that based on how I see students coming back with multiple queries, I feel I can say this, that options is one of the most technical topics. It's not what I feel, it's based on the kind of queries that the quantum of queries which I get about options. Now this video is obviously dedicated for revision series, but apart from this guys, there are some, so here I will still be rushing up through the concepts, but still there are some decent speed videos which I use for my regular class. Those videos are already posted about options, so if you want to go slow with options, it's better you watch those particular videos. It's there on my page. If you just want to revise everything quickly, saving your time, then go for this particular video. Okay, and I repeat it again, if you're a first time viewer and you think that I can listen to this video and gain knowledge about options, please don't see this video. Please don't waste your time and curse me later. Please don't do that. Better you go and see my other videos where I have discussed about options in great details. Okay guys, best of luck. Let's start. So the first thing is, what are the similarities between options and futures? Are there any similarities? Yes, there are some similarities. What are those similarities? The similarities are, both are exchange traded. Because both are exchange traded, so both will take place through BSE and SE. Both are non-delivery based. In both the markets, delivery under any circumstances is not possible. Let's be very clear about it. No shares are delivered, no currency is delivered. Although in the language we use that I have a right to buy the share, I have a right to sell the share, but please don't confuse yourself. Actual delivery is not going to happen. That's a language we speak so that we understand under what options, under what scenario the option will be exercised and under what scenario option will be lapsed. But that does not mean there is actual passing on of ownership happening. That does not happen. For that, only market available is cash market. We know that, right? Next, is there any other similarity? Yes, options also come in 3 months maturity, 1 month, 2 month, 3 months maturity, with settlement happening on the last day of last Thursday of the month of maturity. In exam they can give you a longer maturity, we know that. Apart from that, the options will also have the margin requirements, and it is subject to M2M also. Mark to market is also done. Okay, so these are the things which we have which we know are similar between futures and options. How many types of options are there? It depends on your belief, whether you are bullish or you are bearish. If you are bullish, then you can buy a call. That is a call option. And call, so basically the two options, one is call option, one is put option. If you are bullish, then you will be buying a call. So now if you remember, I've told like this, that whenever you are dealing with options, you got to remember that there are two things we do. First, we take a position in the options market. As a result of that, we get a right on the asset. By taking a position on the options, we get a right or obligation on the asset. So the first thing I do is I buy a call. If I buy a call, I get a right to buy the stock. Okay, I'm talking about stock right now. Obviously, apart from stock, it can be currency, it can be any other asset class, but right now I'm only talking about equity shares. So I get a right to buy the stock at a specified price, and that price is known as the exercise price. Correct? No, strike price or exercise price as we call it. So you first need to buy a call. If you buy a call, then you will get a right to buy the stock. Now guys, the best way to remember this is that whenever we are bullish, we would buy the stock. Try to link it like this. Whenever we are bullish, we will try to buy the stock. Bullish people will buy the stock, bearish people will sell the stock. If you want to have a right to buy the stock, then it is a buying a call. It is buying a call. Similarly, if you take an obligation to buy the stock, if you take an obligation to buy the stock, see, this part is still the same. At the end of the day, you can never make a mistake if you stick to your basics, and basics are very simple. If I am bullish, I will always buy a stock. If I am bullish, I will always buy a stock. Now, either there can be a right to buy the stock, or there can be an obligation to buy the stock. If there is a right to buy the stock, it becomes a call, that is C plus. If you remember, we call it as C plus, guys. And if there is an obligation to buy the stock, then we refer to it as P minus, which means bullish people in the market can do two things. Bullish people in the market can do things. Either they can have a call plus, or they can have a P minus. If you have a call plus, it means you have a right to buy the stock. If you have a P minus, it means you have an obligation to buy the stock. But in both these strategies, one thing which remains clear is that bullish people will always buy the stock. Just focus on what I am encircling in yellow color. If you remember this, that bullish people will always buy the stock. So either they can have a right to buy the stock, or they can have an obligation to buy the stock. Right to buy the stock is called C plus, obligation to buy the stock is called P minus. If you remember the basics, then you need not learn these strategies. You can simply understand them and execute an exam. No need to learn them. I don't want you to learn that bullish people will buy call, bullish people will buy call, bullish people will buy call. Not like that. No. We never studied like that. So we're not doing it like that even in future. We want to understand things. Okay, if you are bearish, so you know the end result. Bearish people will always want to sell the stock, correct? No. So bearish people would like to sell the stock. So one thing is clear, that there will be a sell the stock. Now the question is whether you have a right to sell the stock, or you have an obligation to sell the stock. Either you have a right to sell the stock, or you have an obligation to sell the stock. Give me 1 second, I'll just copy it over here. Yeah, either you can have a right to sell the stock, or you can have an obligation to sell the stock. When you have a right to sell the stock, so obviously if you have a right to sell the stock, it means P plus, and if it is an obligation to sell the stock, then it will be C minus. Right to sell the stock is P plus, obligation to sell the stock is C minus. So if I try to go by the basics, focus on what I am encircling in green. Bearish people will always sell the stock. Either there will be a right to sell the stock, or there will be an obligation to sell the stock, which means bullish people will always buy the asset, bearish people will always sell the asset. For buying the asset or selling the asset, either you will have a right or you will have an obligation. For having a right, you always need to buy the option. Remember that. For having a right, you always need to buy the option. Do you understand what I said? For having a right, you always need to buy the option. So whenever you take a right to buy the stock, you are taking C plus, and whenever you have a right to sell the stock, you take P plus, which means you buy a call to get a right to buy the stock, and you buy a put to get a right to sell the stock. If you remember, I told you in the class, when you are doing sums, okay, you understand all four of them, but when you are doing sums, you will only focus on two people, C plus and P plus. Why, sir? Because see, whatever is the right, okay, now I hope this part is clear. If I can proceed with this, if I only talk about call now, so there are two people, one is C plus, one is C minus, because when the trading will happen, then trading will happen between these two people, right? A buyer and a seller. So there is a buyer of a call and there is a seller of a call. Buyer of the call is C plus, seller of the call is C minus. So this is a right to buy. So obviously this has to be an obligation to sell. And that's what you did exactly here. See, C minus is an obligation to sell. C minus is an obligation to sell. Which means if this person is bullish, not foolish, bullish, then this person is bearish. And obviously markets are made up of two people who think contradictory to each other. Markets are made up of two people who are thinking opposite direction. One thinks stock will go up, one thinks stock will go down. So one person's right is other person's obligation, and if you have a right to buy, the other person automatically has an obligation to sell, not obligation to buy. Two people cannot have buy options. One has a right to buy the stock, other has an obligation to sell the stock. So remember one thing, you can take a note of this, what I'm saying. In order to enjoy the right, whether right is to buy the stock or right is to sell the stock, in order to enjoy the right, the first thing you got to do is you need to buy an option. You need to buy an option to enjoy the right. Till date, the maximum queries which I get from students is, sir, should I take a buy a call or should I take sell a call? Why should we have that confusion in mind? You know one thing, you want to take a right to buy the stock or right to sell the stock, you will have to buy options, because only when you buy options, guys, you will get a right. If you sell options, you will always have an obligation. So whenever you want a right, you need to first buy an option. By purchasing an option in first place, in second place, you will get a right on the stock or currency. I hope I am making sense. Similarly, so basically you understand this, one person will get a right, the other person will have an obligation. Obviously, in order to enjoy this right, the option holder, that is the buyer of the option, will have to pay to the option writer, that is the seller of the option. Option holder, buyer of the option, has to pay to the option writer, the seller of the option, premium. That premium he has to pay upfront. Okay, are we clear on this? The buyer of the option, because when you buy something, guys, you pay a price for that. So the buyer of the option will pay premium to whom? To the seller of the option. Buyer of the option will have to pay the price for that option, and that price of that option is the option premium. That premium needs to be paid upfront. Now suppose, let's take an example. Infosys is trading at 650. That's the current market price. I am bullish on Infosys. I think Infosys will go up. So what I do, at exercise price of 700, I take a call option. C plus I have taken, which means what? Which means I get a right to buy the stock of Infosys at 700 after 1 month, 2 month, 3 month, does not matter. Okay, whatever period they give, that is okay. Suppose premium I have paid for this is 15 rupees and lot size is 1200. Suppose. Now on the maturity, the current market price on the maturity, is equal to 720. How do we talk about it, guys? How do we talk about it? So we say we have a right to buy Infosys because I purchased a call in the first place. So call gave me a right to buy Infosys at an exercise price which is 700 rupees. So I have a right to buy Infosys at 700. And the price in the market is 720. If you remember that unique language we used to talk about in the class, I have a right to buy from you. You remember that language? I have a right to buy from you at 700. In the market, same thing is available for 720. In the market means in the exchange. In the market, if same thing is available for 720, but I have a right to buy from you at 700. Should I be buying it from you at 700 or should I buy it from the market at 720? Should I be buying it from you at 700 or should I buy it from the market at 720? Answer is obviously I'll buy it from you at 700, which means I will exercise my option. If I exercise my option, what we get is called payoff. Payoff is the difference between the current market price and the exercise price. How much payoff will I get, guys? 20 rupees. How much is the premium I paid initially? Premium I paid is 15, which means I make a profit, net profit of 5 into number of lots into lot size, which is 1200 into 5 is 66,000. I made a profit of 6,000 in this case. I hope, guys, this is clear. Okay, and suppose I'm taking one more example and I'm talking from C minus perspective now. So obviously who will take C minus? Let me think, sir. C plus we take when we are bullish, which means C minus we take when we are bearish. Very good. Okay, so you, let's say on Reliance Facebook deal has happened, 9.99% stake sold to Facebook, and the stock is like skyrocketing. It has gone past 1400. I hope you are aware about it. Okay, you need to follow news. I have told this many times. Even if you have exams, some basic news you should always follow, guys. So Reliance is trading above 1400, and you think that, okay, what if Facebook has taken 9.99% stake? Does not mean that stock will skyrocket like this. So you feel the stock at its current market price of 1420 is unjustified. You take a C minus at 1350. C minus at 1350, and let's say premium is equal to 20 rupees. and obviously you will be happy because this premium is an inflow for you because you sold the call option and you get the premium of 20 rupees. Okay, whatever be the maturity later on maturity, price is equal to 1320. Let's say price is 1320. Okay, price is 1320, lot size is 500, number of contracts you have taken is 5, let's say. Now if you remember guys, I told you something, that when the sums will come in exam, you will always think from C plus perspective. You won't do the sum from C minus perspective, you will always do it from C plus perspective. So from C plus point of view, if I think, then in that case C plus has a right to buy from me at 1350. C plus has a right to buy from me at 1350, but in the market same thing is available for 1320. In the market same thing is available for 1320. Will he buy from the market at 1320 or will he buy from me at 1350? Obviously he will buy from the market at 1320, which means option will lapse against us. If option will lapse, then my payoff is equal to 0. Think about it, because whenever option lapse, payoff will be 0 guys. Simple. Whenever option will lapse, payoff will be 0. He has a right to buy at 1350. Same thing is available in the market at 1320. So obviously in this case payoff is equal to 0. For me it is a good news because I received the premium of 20. That becomes my profit because I received premium of 20 in the beginning into 5 into 500. That's my total profit. 20 into 5 into 500 is my total profit. I hope guys this is fine. Okay, and like we discussed about call option, here we are discussing about put now. Okay, put, either you take P plus, that is you buy the put, or you take P minus, that is you sell the put. The people who buy the put will have a right, the first thing, and they will have a right to sell, and this guy will have opposite. Right becomes obligation, sell becomes buy. Right to sell is P plus, and that people will do when they are bearish. Right to sell what? Right to sell the stock. So basically if you buy a put option, you will get a right to sell the stock. Now this is another point where students get confused. They feel I want to sell the stock, so I should sell a put option. No, never say that guys. I request you, please don't say that. I get tens of hundreds of messages on a regular basis that, sir, here I want to sell the stock, no, so I should be selling the put option. Why would you sell the put option? See, only when you buy the put option, because I told you to get a right you need to buy the option. Learn this by heart guys. Write it on a board, write it in your bedroom in bold and clear. Whenever I need a right on the stock, you need to buy the option and pay premium for that. Matter close. Let's not discuss on this any further. So if you want to sell the stock, and to sell the stock you want a right to sell the stock, first you need to buy a put option. That's it. So first you need to buy the put option, and people will do that when they are bearish. Obviously then people will take P minus when they are bullish, which means if you see this carefully, a bullish person can do two things. Either he can do C plus or he can do P minus. If you do C plus, you need to pay premium. If you do P minus, you will get premium. If you do C plus, your loss is limited to the premium paid. If you take P minus, your loss is unlimited. Similarly, people who are bearish can do two things. They can either take P plus or they can take C minus. So bullish people have two things, bearish people have two things. Bullish people can take C plus or P minus, bearish people can take P plus or C minus. I hope this is clear. Understanding wise we should know all four, but sum solving wise we should know only two. Whatever C plus will do, that will be obligation for C minus. Whatever P plus will do, that will be obligation for P minus. I hope this is clear guys. So P plus and P minus. Let's take one example from P plus perspective. Let's say okay, let's say Lupin is trading at 850. Okay, today's price of Lupin is 850. You think it will go down, you're bearish. This is current market price. So what do you take? You take a P plus at 800. That is a right to sell at 800. Obviously you have taken put, you have purchased a put, which means you want a right to sell. And why would you sell this stock? Because you're bearish on it. That's a simple understanding. Okay, lot size is, let's say, 800. Number of contracts is 1. Premium will be an outflow because you're purchasing the option. So premium in this case, let's say, is premium in this case is, let's say, 17 rupees, and on maturity price is 830. Okay, on maturity price is 830. Very, very simple, guys. Think about it. Think about it. I'm giving you 10 seconds. Done. 10 seconds over. Okay. What happened in this case? I have a right to sell at 800, but in the market price is 830. Guys, think about it. I have a right to sell at 830. I have a right to sell at 830, but in the market. But if I sell it to you, I will have to sell it at 800. Will I sell it to you for 800, or will I better sell it in the market at 830? I'll go to the market and sell it at 830, which means my option will lapse and payoff is equal to 0, which means whatever premium I have paid. How much is the premium I paid, guys? 17 rupees. That becomes my loss. My loss is 17 into number of contracts is 1 into 800. That's a loss amount. Simple. It's very simple. Let's not make a hue and cry about options. It's simple, guys. So loss is 17 in this case. Next, let's take an example on P minus. Okay, P minus means bullish. Tata Steel is trading. It's actually cheap, guys. You can buy it. I'm telling you, giving you equity advisory for free. Tata Steel is trading at around 2. I'll tell you the exact price right now. Later you will say KP sir is giving wrong price information in the class. Tata Steel 265, I think. Okay, 270 it is. Tata Steel is trading at 270. If you have 1 year time horizon in mind, you can buy this stock. Okay, we'll talk after 1 year. Tata Steel is 270 and you are bullish on it. So what do? You take P minus at 300. Maturity 3 months, forget about it, we don't care. Number of lots 1, lot size 1500. Let's assume that. Okay, P minus I do, premium will be an inflow. Let's say premium is 8 rupees. So premium is an inflow for you. Inflow. Okay. On maturity, S is equal to 310. 10 seconds starts now. Think about it. $15 seconds given, guys. I have an obligation. Don't think from my perspective. First of all, think from P plus point of view. What is P plus having? P plus is having a right to sell at 300. P plus is having a right to sell at 300, but in the market he can sell for 310. That is the today's current market price. So will he sell it to me for 300, or will he prefer to sell in the market at 310? Obviously he will sell it in the market at 310 and option will lapse against me, which is actually good. I want option to lapse against me, and payoff in this case is 0, which means whatever premium I received in the beginning. How much is the premium? 8 rupees is the premium. That 8 into number of contracts is 1 into lot size is 1500. That is my total profit. I hope, guys, this is clear. I hope this is clear. The option will lapse. Whatever premium I received in the beginning will become my income. So one type of questions which can come in exam is speculation using options. Speculation using options. And speculator can only have two beliefs: either you are bullish or you are bearish. Bullish people can do C plus or P minus. Bearish people can do P plus or C minus. Just remember, when you take the right, you buy the option. When you take the obligation, you sell the option. When you buy the option, you pay premium. When you sell the option, you receive premium. That's the two kind of questions which can come. Apart from that, if you remember in speculation, I told you there are two strategies which I want you to remember by name. One is straddle, one is strangle. And if you remember, I told you one more thing. There are many other strategies like butterfly, bull, bear, strip, strap, all those strategies. One example is given in the book, but on exam day you can avoid doing it. Only two strategies I want you to remember. One is straddle strategy, one is strangle strategy. Straddle is P plus C plus at same exercise price. That is called long straddle strategy, or P minus C minus at same exercise price, same maturity on same stock. That is short straddle strategy. That is, you take both call and put option on the stock at same exercise price. You take both call and put option on the same stock at same exercise price. If you buy the options, it's called long straddle. If you sell the options, it's called short straddle strategy. Strangle strategy is very similar to straddle, but only difference is here you take the call option at a higher exercise price and put option at a lower exercise price. If you buy the call at higher exercise price and buy a put at lower exercise price, we refer to it as long strangle strategy. If you sell the call at higher exercise price and sell the put at lower exercise price, it will be called a short strangle strategy. Long and short word will depend on whether you are taking a long position, that is buying the options, or selling the options will be short position. I hope guys this is again clear to you. After that, we move on to the next important point of discussion, which is how hedging of the transaction exposure can be done. Hedging transaction exposure using currency options. Hedging transaction exposure using currency options. For this, I told the first important thing guys you need to do is understand home currency options in foreign currency and foreign currency options in home currency. If you remember, exact chart is made in your class notebook also. This comes 98% of the times and this will come 2% of the times. Mainly we will be having sums on foreign currency options in home currency. How do I know which currency option is available? There are two methods to check. One is the lot size. Lot size will define which currency option is available, and second is the premium currency. This is the two methods I told you to figure out whether the sum has come from left hand side category or the right hand side category. Currency premium, the currency in which premium is given. If the premium is given in rupee, it automatically means option is available in India, and in India you can't have rupee options, so then it becomes a sum of the second category, which is foreign currency option in home currency. As an Indian, if we are paying premium in rupee, it means dollar option is available in India. If premium is in dollars, it means option is available in US, and in US you can't have dollar options, so in US you have rupee option. So like that you will bifurcate which option is available. If lot size is given in dollar, that means it is dollar option, and if it is dollar option, then option is available in India. If lot size is given in rupee, it means it is rupee option and it has to be available in US. I hope guys this is clear, right? So if foreign currency option is given in home currency, two cases. If we have dollar payable, so focus on dollar. What we have to do with, because it is dollar option, dollar payable. So payable means you need to buy dollar. Payable means you need to buy dollar. So you can have a focus on the word buy. So you can have a right to buy dollar or obligation to buy dollar. Right to buy dollar is C plus. We just discussed guys. Right to buy C plus, and obligation to buy is P minus. Very simple. We need to decide what we do with options for hedging the currency risk. If you need to pay dollar, you will have, so focus on the word to pay dollar, I need to buy dollar. To pay dollar, I need to buy dollar. Therefore we can have a right to buy dollar or we can have an obligation to buy dollar. Right to buy dollar is C plus, obligation to buy dollar is P minus. Case 2, dollar receivable. If we have dollar receivable, now you know receivable means you will get dollars and you will sell dollar. So either you can have a right to sell dollar or you can have obligation to sell dollar. Right to sell dollar is P plus and obligation to sell dollar is C minus. Right to sell dollar is P plus, obligation to sell dollar is C minus. This is how you decide guys. It's very simple. Home currency option in foreign currency is given. Same examples I am taking. Dollar payable, but it is a rupee option. This is a case of rupee option in US. If I have dollar payable, how do you think? Dollar payable means buy dollar, that is sell rupee. Now focus is on sell rupee because rupee options are available. So sell rupee means two things: right to sell rupee or obligation to sell rupee. Right to sell rupee is P plus and obligation to sell rupee is C minus. Clear? Case 2, dollar receivable. Dollar receivable, you will receive dollar, you will sell dollar. So sell dollar, that is buy rupee. Buy rupee, focuses on buy rupee because rupee options are available. Right to buy rupee, obligation to buy rupee. Right to buy rupee is C plus, obligation to buy rupee is P minus. So this is how you decide what strategies to be used. Okay. Apart from that, if you remember that Mr. Dayal sum we have done, guys, in the class, and I told you that whenever you have taken C minus, you have sold a call, which means you're bearish. If you've taken a C minus, that is you are bearish, so you would be worried about stock prices going up, because bullish people will buy call, bearish people will sell call. If you sell the call, you're worried about price going up. One way to hedge against this is by purchasing the stock itself. One way to hedge against this is by purchasing a stock itself. Okay, and if we are planning to hedge, the option writing, call option writing with the stock buying, then how many stocks we should buy for every one call option sold? How many stocks we should buy for every one call option sold? That we need to understand, correct? And if you remember, for that we calculate something called as hedge ratio. I hope you remember this. We calculate something called as hedge ratio, and hedge ratio is calculated as, if you remember this, hedge ratio is calculated as C2 minus C1 divided by S2 minus S1. C2 minus C1 divided by S2 minus S1. That is how much is the call. This is the basically call payoff on upside and downside stock price, and this is the stock upside and downside price. This is stock price. Okay, which means hedge ratio will help you understand for every one call option sold how many options you will have to for every one call option sold, how many stocks you will have to buy. We did a sum. Mr. Dayal is interested in purchasing the stock of a company, like that it starts. That particular sum is important, guys. Okay, so whenever you sell a call option, you are worried about stock price going up. Whenever you sell a call option, you are worried about stock price going up. If you are worried about stock price going up, one way to hedge against it is by buying a stock. For every one call option sold, how many stocks we need to buy to create a perfect hedge? For that we use hedge ratio, where hedge ratio is equal to C2 minus C1 divided by S2 minus S1, where C2 and C1 are call payoff on upside and downside, S2 and S1 are upside and downside stock prices. Okay, after that we did something called as pricing of options. Option pricing is nothing but the premium you pay for the option. For that we use two models. The first model is binomial model. I hope you remember this. The first model is called as binomial model. We can have a binomial model, single period, two period. If you remember, in a single period binomial model, first thing what we studied is that stock price can only take two values. That is, either it can go up, that is upside stock price, or it can go down, that is downside stock price. You remember this. Stock prices on maturity can only have two values, upside and downside stock price. And apart from that, we studied that we always use risk-free rate as a discounting rate, and the risk-free interest rate factor is given as capital R, which is equal to 1 plus RF. Capital R is 1 plus RF. Okay, so S can go up to upside stock price or downside stock price. They will give you an exam, stock is expected to go up to this price, or they will write the stock is expected to go up by 10% or down by 5%, like that they will say. Then we need the probabilities, that is P and 1 minus P. The upside probability, that is P, is calculated as U minus D divided by R minus D, where U and D are up move and down move factor, which means if the stock is expected to go up by 10%, then up move factor is 1.10, which is 1 plus 10%, that is 1.10. And if the stock is expected to go down by 5%, then the down move factor will be 1 minus 5%, which is 0.95. So U and D are calculated like this. After that, U and D are calculated like this. Apart from that, capital R, as I told you, is 1 plus RF. But you need to be careful. If the binomial model is for 6 months, then first you need to convert this into 6 months equivalent, which is 4%, and then you will make a factor, that is capital R, which is 1.04. Like this you have to do. I hope you are able to recall all these things. So P is U minus D divided by R minus D. Once we calculate P, suppose P is 0.54, then 1 minus P is obviously 0.46. Okay. Now we want to calculate the price of a call at this point of time. So we have a discount rate which is 4% in this case. The adjusted time adjusted discount rate is 4%. So first thing, guys, that you do is you calculate the payoff from the call at this point. You calculate the payoff from the call at this point, that is if stock price goes up, then how much will be the payoff from the call option, and if the stock price goes down, that is DS is the price, then how much is the payoff from the call option. You take those call option payoff and you discount it back. The entire binomial model is based on backward the discounting of payoff method, that's called backward induction method. We discount the payoff and calculate its present value today. So C0 today is call payoff on the upside, okay, into P plus call payoff on the downside into 1 minus P. That is taken divided by 1 plus RF, or as you call it as capital R. Same ways you do it for call and same ways you do it for put, only differences in case of call and put the payoff will be different. Your calculations of P, 1 minus P, U, D, R, F, all those things are going to be same. If it's a 2-period binomial model, then what happens is we divide the entire period into 2 equal parts depending on the option maturity. So if option maturity is 1 year, then we divide it into 2 equal parts of 6 months each. These 2 equal time intervals will depend on the total option maturity. So for 6 months, price can go up from A to B or go down from A to C. Second 6 months, from B it can go up to D or it can come down to E, and from C it can go up to F or it can come down to G. Then what is the thing we do? P and 1 minus P calculations are exactly the same, guys. R minus D divided by U minus D, we use the same. P is equal to, okay, I think I've written the wrong formula here, I'm sorry for that. P is equal to R minus D divided by U minus D. Not sure, I'm getting confused about it, guys, I'm so sorry for that. Okay, I think this is R minus D divided by U minus D. If I made a mistake, please give me a second, please. This never happens. This never happens with me. Just give me a second. I don't want to take chances. I'll just cross check. Give me 1 second, please. 1 second, guys. I think it is R minus D divided by U minus D. Yeah, it is R minus D by U minus D. Sorry for that. Okay. So P is R minus D divided by U minus D. Same formula, guys, you will use here, and you will calculate the P values and 1 minus P values. Then after that, what you need to do is at D, E, F and G, you need to calculate the payoff. The first thing you got to do is you need to calculate the payoff at points D, E, F and G. Now listen carefully. If it's a European option, what is a European option? European option is an option which can only be exercised on its maturity. American option is an option which can be exercised at any point of time on or before maturity. I hope you remember that. So if it's a European option and you can only exercise it on maturity, then what you will do, listen carefully now, is the first thing you do is at D, E, F, G, you calculate the payoff from the option. D, E, F, G, you calculate the payoff from the option. Then you take the payoff at D and E, discount it back to B. Take payoff at D and E, discount it back to B. Take F and G, discount it back to C. Take F and G, discount it back to C. Once you get the discounted value at B and C, then discount it back and calculate the answer at A. That is the value of the call or value of the put at A. First thing, you calculate the payoff at D, E, F, G. Then from D, E, you discount it back and calculate the answer at B. Take F, G, discount it back to C. Take B and C, discount it back to A. That's how you do it, right? Now, if it's a European option, this method is absolutely correct. But if it's a American option, then you need to do a little bit of extra work, because American option can be exercised at any point of time on or before maturity. So for an American option, what we got to do is calculate the payoff at D and E, discount it back at B, calculate payoff at F and G, discount it back at C. Now at B and C, you will compare between discounted value and payoff. Same thing you will do at C, discounted value and payoff Payoff is what you get by exercising the option immediately. So the point is, at B and C, you will take higher of discounted value and payoff. The reason for that is, if a trader can get more money by immediately exercising the option, then he will prefer to exercise it and get the higher amount. He will not wait till maturity. So we take higher of discounted value and payoff at B and C. And because you can exercise immediately also, so even at point A, you will take higher of discounted value and payoff. Even at point A, you will take higher of discounted value and payoff. I hope guys this is clear. Okay, so this is how we have to proceed. In case of European option, just 2 times you do the discounting from DE to B, from FG to C, and then take B and C discounted value and discount it to A. But if it's an American option, DE to B, FG to C, then at B and C take higher of discounted value and payoff. Again from BC you take it back to A. Okay, and again at A you do the comparison of discounted value and payoff. Another method, which is a terrible method, which we don't like, and it does not come in the exams also much, but we still need to do it, is called Black-Scholes model. I hope you remember Black-Scholes model. How the pricing of call option is done. This is how we do it. This is the value of a call option, which is C0. C0 is equal to S0 into ND1 minus E divided by E to the power RT into ND2, where S0 is the spot price. ND1 and ND2 refers to the normal distributions, which value we will find from the normal probability distribution table. E is the exercise price of the option, and R is the risk-free rate. T is the time to maturity of the option. Before we do that, first we need to calculate D1 and D2. So D1 is equal to ln S0 by E plus R plus sigma square by 2 into T divide by sigma root T. That's how you calculate D1. All formula oriented guys. Even if BSM comes, we should not feel bad about it, because if you know the formula you can calculate it. Ln S0 by E plus R plus sigma square by 2 into T divided by sigma root T. Sigma is the standard deviation, that is volatility captured through sigma. That values will be given to you. Ln is the log natural values. The log natural values will also be provided to you. This is how you calculate D1, and then you calculate D2. First you calculate D1 and D2, then you calculate ND1 and D2. Then you calculate D2, which is D1 minus the denominator of D1, which is D2 is equal to D1 minus sigma root T. D2 is equal to D1 minus sigma root T. Once you calculate D1 and D2, now listen carefully. Once you calculate D1 and D2, you can have two cases. Case 1, the value of D1 and D2 are positive. If the value of D1 and D2 are positive, then we take 1 minus table value. You remember that? Then we go to the table, normal probability distribution table. Whatever value you get over there, you do 1 minus the table value, because we need the area on the left hand side. Positive values means we have the area on the right hand side, but we need, for BSM purpose, we need the area on the left hand side. So what we do is we take D1 and D2 table values, and then the ND1 is equal to, okay, I'll write it, if D1 and D2 are positive, then ND1 is equal to 1 minus table value. Now making sense? If D1 and D2 are negative, ND1, negative means it's already on the left hand side. ND1 in that case is directly equal to table value. So if D1 and D2 are positive, we take it as 1 minus table value. If D1 and D2 are negative, we take it as table value. Once you get the value of ND1 and D2, you can put it in this equation and calculate the value of a call option. For the calculation of the value of a put option, I told you we consider the put call parity equation. First you calculate the value of a call, and then you put it in this equation of put call parity equation, which is P0 plus S0 is equal to C0 plus E divided by E to the power RT. That is, we have two portfolios. One portfolio is called the protective put, where we take a put option and a stock at its current market price, and we have a fiduciary call, where we take a call option and a zero coupon bond whose exercise price whose face value is same as the exercise price of the option. We take this, we put this and this you just calculated from BSM, and based on this you calculate the value of a put option. I hope guys this is clear. So we covered everything in the options. I hope you are happy now. I know I was a little fast, but we can't help it, because this is only revision series, so we have to make it look like revision series and not the conceptual class where I'm teaching you the concepts. I hope guys this class is useful. If you like it, please leave a thumbs up and please leave some message in the comments. I love your comments guys. Thanks a lot for all the beautiful comments you have written so far. Every time you write a nice comment, I take it and I post it on my status, I post it on Instagram, I post it on LinkedIn and whatnot. I post it everywhere. Yeah, if you write a bad comment, then I just ignore it. Ignorance is bliss, you know. Okay guys, thank you. Bye bye. God bless. Ciao.